Hello, everyone. It looks like we're good to go. Looks like YouTube Live has said to me, you're live. So I hope that means you can hear me. If you can hear me, say g'day. We've got Plant One already said howdy, and Jonesy said, g'day, Owen. Let's make it a great session. Yeah, let's make it a great session. We've got heaps to go through today, so I won't kind of dilly-dally with kind of a preamble or anything like that. Just jump in there and say g'day and let me know that you can hear me. Cool. Hello, says Reit. Cool. Wonderful. Plant One says, I've got my HZR. Got my HZR from SPP. Very happy. Wonderful. So share purchase plan. Lovely, lovely, lovely. So we've got a few things to talk about today, but one kind of overarching thing, which is this idea of passive income from the share market. This is, I guess it's like one of the most Googled things on the internet because people love this idea of earning an income, getting wealthy, staying wealthy, being wealthy by letting your money talk for you and earn for you. So good morning, says Michael. G'day, says Migration Nation. Wonderful. I'm joined by Rob today. Rob's also in the chat, so you may see some general advice disclaimers. And if you need any support questions answered, Rob might be able to help you out here. But to be honest, the easiest place to go is selfwealth.com.au. Hit the live support button there, the widget in the corner, and they'll be able to help you out with any account-related stuff. As always, I'm here to answer and talk about investing. We all love investing. That's why we're here today. And any of the answers that I give are limited to general financial advice only. So what that means is if I answer a question in the live chat, you can just stick a question in there. I love a bit of conversation. It really makes these sessions really great. Just remember that if I do answer a question, I don't understand or I don't know your personal situation, your needs, your goals, or your objectives. So anything that I comment on is limited to general financial information only. You can read the SelfWealth Financial Services Guide, FSG, on the website, or you can read my company's FSG, which is the Rask Group's FSG on rask.com.au. Okay, cool. Without further ado, my name is Owen Rask. I'm the founder of Rask Australia. I'm an analyst by day, podcast host, and I do a few other things around the side, including some random scribbles on a whiteboard every now and again when I can't really think clearly. So today we're going to be talking about passive income. We've got heaps of comments, no doubt, about this coming through. And it's one of those things where people are, there's two sides of the coin in the stock market. One is let's get some growth. The other side is how do I make an income and kind of make my money work for me. So what's really interesting is when I first interviewed, or not first time I interviewed him, but the second time I interviewed Hamish Douglass, who's the founder and chief investment officer of Magellan Financial Group. Many of you will know of Hamish. He's a billionaire. He runs a multi-billion-dollar company, basically, even though he has a CEO. And he's just probably the Australian investor of the past 20 years. Most people in financial circles kind of regard Hamish as the investor in Australia. And what's really interesting about him is he had this comment for me the last time I spoke to him. He said, the money that money makes more money. And I thought that was really profound, just the way he summed that up. The money that money makes more money, and that's compounding. And so that's a big part of what we're going to talk about today. Making your money make more money, and then that money that it makes some more money. So how are we going to do that? We're going to talk about how to build a portfolio from scratch. We're actually going to jump outside of the SelfWealth website quickly. We're going to talk through some strategy. Then we're going to dive into SelfWealth, get to know some companies and some ETFs and some LICs and some Reits and all that sort of stuff. And then we're going to dive back into a spreadsheet and we're going to keep going from there and there and there. Yeah. So what's really, what I should remind you of is that we actually have some really interesting episodes coming up of SelfWealth Live. You can use the hashtag SelfWealth Live to follow us on social media. But we're actually going to be talking about how to invest for kids and how I would invest for kids in a future episode. So you can actually stay tuned. The easiest way to do that is to subscribe to the SelfWealth YouTube channel. So investing for kids is coming up. And many of you will know that there is a feature on SelfWealth where you can effectively have a trading account for kids, or you can invest on their behalf, which is super popular. I know it's not, I've got a younger sister. I used to invest for her. Grandparents love to invest for children. Even aunties and uncles and relatives love to invest for the family members. So really, really interesting. Okay, so Amit says, morning everyone. Chanda's back again, says hi. Wonderful to have you with us, Chanda. Okay, so what we're going to do is we're going to dive into a little thing that I've put together for you just around basically kind of let's just set the groundwork for what we're trying to do. So I'm just going to jump in there now. So as you can see, I've got my SelfWealth count fired up here. See what the ASX is doing today. Okay, the Australian market is down 0.5%. On days like today, I tend to get more excited than I do anything else. It tends to be a good opportunity to go shopping. So what we're going to do is we're going to make use of the stock watch list feature down the side here. We're going to add to our companies that we've already covered in previous SelfWealth lives. Again, you can watch all of them on replay on the SelfWealth YouTube page. But before we get to any of the companies, I want to ask you a favor. Can you please, in the chat, pop in your favorite companies, your favorite shares, whether they're ASX or global shares, or whether they're ETFs, LICs, real estate investment trusts. Put in the chat your favorite companies for income. And what I'm particularly looking for is fully franked dividend income if they're Australian. So fully franked, meaning that they pay franking credits, or at least they can. They don't have to, like if they're a Reit, for example. I'd also love for you to, if you can, tell us a little bit about why. I'm really looking for those reliable dividend income companies. Here we go. Okay, so we've got some Berkshire B. Okay, late started today. G'day, Gilly Monster. Great to have you with us, mate. You haven't missed anything right now. Whoa, we've got some great companies coming in. Plant One says Facebook for a dividend income play. Plant One. Does Facebook pay a dividend? Pay a dividend, sorry? Interesting. We'll get to that in a few moments. Let's dive into what I've prepared for you. Okay, so passive income from the stock market. This comes back to basically having a plan. In my opinion, no matter how you invest, you should have a plan for what you want to achieve. So here on the page, and I'll zoom in just a touch, we can see that I've put some prompts in to get us thinking. Obviously, anything that I talk about today is just kind of generalized. I'm not, tailoring it to you or even to me, to be honest. This is just kind of a general look and feel. I've got a heap of companies to talk about, a few ETFs and that type of thing. And so the first thing we want to talk about is when we have a plan, is we want to understand our risk tolerance. Yes, we're getting some great names coming in. Gear, we've got, what is that? Atlassian, we've got Batcore, Spark, PGC. Interesting, lovely ideas here. These are really interesting. Some of them I haven't thought about. Okay, so we've got risk tolerance. Basically, your risk tolerance comes back to your personal financial situation. If your finances are a mess, then it's going to be hard to invest for the long term because you will always feel a bit more stressed out than most. So one thing that I always advocate for when I speak to people is making sure you have that emergency fund. Any money that you have set aside in a rainy day fund for things like medical emergencies, car breaks down, mortgage repayments, rent, whatever it is, that stuff is not portfolio money. That's money that's set aside to keep you thinking clearly when the stock market crashes and you want to put money to work. If you have an income, so this is one for the people that are on their bridge of retirement, if you have an active income, so you have that kind of tap, that faucet of income coming in, you will feel more secure in your risk-taking ability. So you tend to feel more, as soon as that income or salary gets turned off, people freak out and they're like, okay, hold on a second, now I need to take this seriously. So that's really interesting. Okay, so so basically, if you have your finances in order, you've got a stable income, and you have like the temperament for it, I should probably add that in here, temperament, you'll have a better chance of taking on more risk. Maybe not. Typically, an advisor will help you with that section. The longer you have to invest, typically the more risk you can take, which means that you can take more risk on different shares or income stocks. But also, more time to prepare, more time to compound if you go back to that first thing and build a solid base. Okay, so Chris has said SLX, AXE, and HZR. I think Plant One may own HZR, so that's an interesting one. Basically, the shorter your time frame, the more defensive you need to be. When I speak to people, they basically say to me, hey, Owen, I'm going to retire in 3 years. I need to sort out my income from my portfolio ASAP. And I say, well, 3 years this time around is actually pretty sensitive time. 3 years doesn't give us a lot of time, so start planning ahead of time so then you can set your plans in motion earlier. Okay, there are some goals here that we're going to set for a portfolio. When you set out investing, you basically say, I want to earn 4% income from my portfolio. I want to have $50,000 income per year. I want to retire with $1 million. There are basically multiple different ways that you can set a goal in investing. This is called goals-based settings, I guess. And one of the things that's really interesting around this is that many people tend to assume the 4% safe withdrawal rate. So if you go to a financial planner, they'll basically say, we're going to try and get 4% from the portfolio every year. And that will be your money just to replace your income. So for example, a family member of mine not too long ago went to see a financial planner. They're entering retirement and they wanted to achieve $80,000 a year of income. And the financial planner said, just as a rule of thumb, okay, we're going to need, if that's basically 4% of the total portfolio value, we're going to have over $1 million in there. So that's basically how you do it. Yupendra says, will this video be available to watch after the live session? Absolutely, it will be. So go back and watch it. It'll be available on the SelfWealth YouTube channel. Okay, the safe withdrawal rate, or the 4% rule, so this one here, is basically assuming that you can take 4% out of your portfolio if you achieve a 7% return on average and inflation is 3%. So if you achieve a 7% return and inflation's 3%, that would leave you with 4%, which would keep your portfolio basically in line with inflation every year, so it's not getting eaten away. Okay, so basically we would sit down, or a financial planner would sit down with you and do these things and determine, okay, how much, based on your risk, based on your objectives, based on all that stuff, now where are we going to go? And most of them come up with this thing called strategic asset allocation, or SAA. And this is basically, the way I think about it, SAA, is basically, what's my big picture? And what's my strategy to get us there? So if your strategy is, I want to retire in 15 years, you would set your portfolio strategy to that 15-year goal. So I want to retire with X amount in the future. What's the best strategy that can get me there with respect to my risk and all the other things that I've got going on in my life? That's how we kind of use it. So we set a goal and then we have constraints or things that kind of compete for that. And we talk about something called SAA. And SAA blends risky with less risky investments to match goals, risk, and timeline. Okay, so here we've got an example of 3 different strategies, 3 different SAAs. One is more defensive. It has 30% in less risky assets. So less risky. Notice how I'm saying less risky and not risk-free. They're not the same thing. More risky. So here, types of risky assets include LICs, REITs, shares, funds, ETFs, investment properties. In a balanced portfolio, might be say, we'll have half and half. We'll have more risky, less risky. And then we'll have cash accounts, term deposits, government bonds, and these three things on the less risky side of things. So if you invest in term deposits, at the bank, and you get an income, that is a type of investment. It's just a very low risk investment. You can take more risk by using things like credit and alternatives and commodities. Some people believe that they work and that they work in times of stress. Interesting. Eugene says, all in on Dodge. Yeah, not sure about that one. That one might be at the hyper end of the risky scale. Correction, defensive should have more, less risky. So defensive should have, yes. So here we go. This is where it gets a bit interesting. Robin says, g'day, Owen, always good to see you. Always good to see you too, Robin, even though I can't see you. Okay, yeah, so Sophie asks, is a cash account something like an ING savings maximizer? Yes, it is. It's exactly what it would be. So that would be like an ING savings maximizer, whereas this would be like a term deposit at CommBank. So term deposits lock your money away for 6, 12, 5 years, however long, whereas a cash account you can access, but it does pay interest. You could also use an offset account. So on the growth, so just in terms of what these represent here, yes, so this one, less risky, more risky. So you were right there. Yeah, Dipin, thank you for that. Bipin, thank you. We've got, so 30% of these assets in a defensive portfolio would be more risky and 70 would be less risky. At the other end, we would be saying 70% more risky, 30% less risky. So let's just go down and see what that means. So we've got some rules for our portfolio, and I'm just about to start jumping into companies. So sorry about the preamble here. It's just, Plant One says Ubank is better than ING. Interesting. That's maybe a contentious one. Plant One. I have looked at the banks in the past, and Ubank and ING are interesting. G'day, Owen, says Jim. G'day, mate. Robin says, Chris, quick questions. Where can we buy government bonds? I'll get to that. That's a good question. So you can actually buy them in your SelfWealth account, which is really interesting. But you can't buy them directly. You can actually, well, you can, but there's probably an easier way to do it. So, so we've got some rules for an income-focused portfolio. So I'm going to say up to 30 investments. Because beyond 30 investments for me, I tend to lose track of what actually is going on. So let's just say 30 investments. Now, these are not investments just in your portfolio. They could be your investment property. They could be if you collect art or custom cars or whatever you think is an investment, up to 30 of them. Diversification. We want to diversify across asset classes, so shares versus bonds versus property, industries, banks versus technology companies, the markets. So we want to have some of our investments overseas, some here in Australia. And provider. We want to, maybe we like Magellan for active funds and we like Vanguard for index funds or ETFs. We just want to mix that up too, just so we're not kind of all in on one provider. Now, interesting one here, acceptance of risk. So I just want to, just one more thing. There's two more things here, but this is the second last one. Most people, when they approach the share market for passive income, they think, oh, I'm an income investor. I'm just going to invest in things that are low risk. Yes, you may do that. However, there is still some risk. Even if you go to Australian Super, the biggest super fund in Australia, on their page for different investment options, they will tell you, even in this conservative option, sometimes the portfolio will go down. And that's really important to remember. Even if you're being very diligent and mindful of the risk, sometimes they go down. So I've written a note here. Even defensive portfolios can go down one in every, say, 5 years. And that's not a forecast, it's just a general rule. But if you prepare yourself for that, you will be much better. I heard one of the greatest quotes of investing that I've ever heard in this respect. They said, investing in the stock market isn't until the next market crash, it's for life. So don't try and get hung up on the next market crash. Try and invest for the rest of your life and see how you go. And finally, let's keep taxes low by avoiding trading too much and avoiding selling, I should say, and maximize those juicy franking credits. Okay, here we go. Let's move on, guys. So I've got a portfolio here and it's not supposed to have 1.5 million. Let's start with $100,000. So here we go. We've got a little spreadsheet that I've put together. And you will remember here that I basically said we're going to build a portfolio. So we're going to start building a portfolio, and I'm going to use the growth portfolio. Another way to think of the growth portfolio is more risk. So more risk, or let's just call it the risky portfolio. All right. And so we're going to create a portfolio that has 70% in more risky investments, so things like shares, that's these things down here, and 30% in less risky investments, so these things down here. And now we're going to show you how you can put those together. So on this tab right here, I've got a very easy way for us to keep track of what we're going to add in. So we're going to add in a LIC, we're going to add in a Reit, a share, so this is going to be a blue chip share, we're going to add in a fund or another LIC, we're going to add an ETF, and then we're going to talk about property and where that kind of falls. We're going to put in the yields, we're going to give it a hypothetical rating, and then we're going to try and work out what our annual yield would be. Further down the page here, we've got some defensive assets. So here we've got things that, probably all of us have. So that's something interesting. So Ali says, why isn't crypto in the conversation? Ali, good question. If crypto was in the conversation, crypto would be, crypto would probably be over here. So crypto assets would probably fall into here. And some people would say that, well, maybe a small amount of crypto might fall into this side because it has lower correlation, meaning that it doesn't always move in the same way. But to be honest, because crypto assets are so volatile, meaning they go up and down a lot, they're typically on the riskier side of the asset allocation. Inflation destroys fixed income, says Zamasu. Interesting observation, and yes, we can definitely talk about that. Michelle says, would love a copy of that spreadsheet if it's possible. Yeah, we'll see what we can do. It's just a very simple Google spreadsheet that I've created. I use Google for everything, even my analyst work. I use Google. So yeah, keep a watch, and I'll see what I can do. I'll see what Rob and I can do. It's just a very simple spreadsheet. I'll see if I can get a link to it and put it in the show notes, perhaps. So, okay, so let's start building this in. Who's got a really good listed investment company that they want to take a look at? I've got a few that I can throw in here, and I've actually pre-filled my notes on this other tab here, so we can have a look at that at the end to see what we're actually looking at. So just for those of you who don't know, a listed investment company is a company that invests in other things. So the biggest one in Australia is WAM. So WAM Capital, I think it's the biggest by assets, but WAM Capital is basically you buy shares in WAM Capital, and then WAM's investment team go and invest the money. Okay, we've had a lot of come through here, and it looks like Argo wins. Well, that's great, because Argo is the one I was hoping you would say. Here we go. We've got RF1, AFIC, so many great ones here. We've got WAM from Tim. Yep. NIO. I don't know what that one is, Ali. Interesting. Okay, so Argo. Let's go with Argo, because this is the one that I did have a look at. So here we go. We're in SelfWealth, and we can see the revenue, EBITDA, and all of these lovely things. Let's just have a read of this description. I'll zoom in a bit. So as we can see here, Argo Investments is an Australia-based investment company. The company operates in the investment industry primarily within Australia. It manages a diversified portfolio of investments. The objective is to maximize long-term returns to shareholders through a balance of capital and dividend growth. This sounds like a good one for our portfolio because it's talking about dividends. The company's portfolio contains investments in companies and trusts representing a cross-section of Australia's enterprises. Okay, so we can see here in the community, how many people in the top 20 own it. We can see ranked by ownership, it's number 48, which is pretty good. And here, the reasons for buying Argo are good dividend paying stock. Well, there you go. That's a good sign. Aligning with target portfolio. Okay, wonderful. Let's take a look at, let's see if we've got it in here. Let's have a look at per share data. So we've got dividends per share, most recent year, 0.28. And we can come down and we can see the 5-year average dividend per share is 0.31, which is pretty interesting. Risk, so Jonesy says, on SelfWealth, forecast risk is high. Let's have a look at this. So where are we looking? Community sentiment's pretty bullish. Let's have a look. Where are we? Why aren't my numbers coming up? Did you say it's a high risk one? I can't see this. Why am I not seeing it? It's because I'm zoomed in. Where are my risk ratings? I'm lost, guys. Can you tell me how to find my risk ratings once again? Cool. Okay, here we go. So forecast. Yeah, sorry, you said forecast. I've got it. Finally, I've caught up. Yeah, so fundamentals look like a 1 out of 10, relative valuation 1 out of 10, risk 10 out of 10. Yeah, thanks, Jonesy. So basically, what might be happening here is basically Argo is a listed investment company. So the ratios that are provided by Refinitiv and the numbers, the way it's calculated, may not necessarily be an exact reflection of the true nature of the business. So keep that in mind before you rely on these for a LIC. Now, sometimes they will work. You know, in the case of the next company, which we're about to talk about, I hope, they will work. But for this company, it's a little bit different in structure. This would be like, imagine if you compared, I guess, the growth rates of Berkshire Hathaway, which is Warren Buffett's company, to say Tesla. They're totally different businesses. So we can use models to kind of analyze them, but we can't use the same one for Tesla that we do for Berkshire. So here we go. We can see the yield just down here, which is what we really want to know. We can see the yield is 3.03%. So let's just chuck that back in our spreadsheet. We've got Argo Investments Limited, and I think that's ARG, and we can put in 3.03. Now, we can also find out if it's fully franked or not. So what we'll do is we'll go into the news and announcements. We'll come into, I'm just going to go price sensitive, and we can see the most recent annual report, and I'm going to download this like I normally do here. Get it up. And then I'm just going to use Command F because I'm on a Mac, and I'm going to go franking. So here we can see that there's a franking balance within the fund. It looks, if it's got a franking balance, it means it's eligible to receive franking credits, which is a great sign. So let's see if we've got fully franked. Notice how I just searched for the term fully at the top here, and you can see the dividends for the year were both fully franked. Interim fully franked dividend, final fully franked dividend. So I'm going to put this in here and say yes. Now I've set up this last column here. Sorry to be moving quite quickly with you guys. This last column here is actually saying to us, it's just a bit of computing, just a bit of algorithm here to explain, to say if the dividend is fully franked, then adjust for franking credits. So what are franking credits? G'day Stevie, happy Monday to you too. So what are franking credits? Franking credits, the way I explain them, are tax credits stored at the ATO for you. So the company is up the top here, it pays tax, then it pays a dividend to you out of the profits. So then you shouldn't pay tax again because the franking credits have already been paid and the tax has already been paid by the company. So the company sends that tax to the ATO and says, store this on behalf of our shareholders. And then you as a shareholder can claim back those franking credits in your tax return. And that's basically how it works. We've got a full video on this on the Rask Australia website if you want it. Okay, so let's just say, for example, that we're going to put 5% of our portfolio into Argo investments. I'm actually going to, I think I can actually do something with you guys here. I think I can. Now, if I give you a link, I can actually share this with you. So let's get this. Let's go. Anyone with this link can be a viewer. There we go. We'll copy that link. You should be able to see Google Sheet this here. Now, just keep in mind that anything that obviously I put in here is just a guide only, right? We're not making recommendations on the companies. So I'm just going to pop that in there. You'll see the link in there. Anything that I put in here is just examples only. So these are not recommendations. We're just building a kind of fake portfolio. And you can see everyone's joining in. Here we go. Everyone can see the portfolio in action. Amy says, if we can get a link on replay, very interesting, thanks. Yeah, sure thing. This is a very, very simple example of how we can kind of plot out the portfolio. Okay, so we know that Argo has a 3% yield based on last year's yield. One of the things that I want to emphasize here is that no company is ever guaranteed to pay a dividend, ever. No company is guaranteed, right? No matter what happens, no company is guaranteed to pay a dividend. Now, you will see that some of the companies that we're going to talk about today have a very reliable track record for paying dividends, but that does not mean they're guaranteed. No one is saying these are guaranteed. I want to emphasize that point. So we can see here on the Argo website that there was a 28% fully franked dividend paid. It's got a very low management expense ratio. It's got 94,000 shareholders. It was started in 1946. Okay, so here we go. And you can learn all about them on this page and what they do, basically. But you can see it was started in 1946. This has been around for a long time. Okay, so here we go down a bit further. We come in and we can see, yes, it's fully franked. We're just going to put maybe even just 2% into Argo. So this is just, again, just a really hypothetical thing. We're not kind of building this from scratch. I'm only going to talk about a couple of companies here today. But we can see back on the SelfWealth website here how, the company has performed. We can see the revenue. We can get a description. We can see what the last dividend was. Remember that the last dividend is not necessarily the full year dividend. And you can see here when the dividend was paid or when it was registered to be paid, which was the 27th of August. When it was paid is the 17th. And you can see all these great stats here on the website. Okay, so the next one, we're going to look for a Reit. Does anyone want to drop into the chat a Reit, a real estate investment trust? Okay, so Zamu says, oh, this is for Argo, says the payout ratio is over 70 or is 70 to 80%, and they don't like anything 70 to 80%. Okay, so CLW seems to be a Reit that people are talking about. Let's have a look at CLW. I don't know. I think this is going to be a Charter Hall Reit. Okay, so here we go. the community has said, let's take a look at Charter Hall. So we can see here that Charter Hall is a real estate investment trust. And we go down to the description. Charter Hall is an Australia-based real estate investment trust. The trust invests in Australasian real estate that are predominantly leased to corporate and government tenants on long-term leases. The trust's objective is to provide investors with stable and secure income and potential for both income and capital growth through exposure to a diversified portfolio with a long WALE REIT. The trust focuses to maintain existing portfolio through active asset and property management. Okay, so basically, what is a REIT? A REIT, or real estate investment trust, is basically a pooled amount of money that then invests into property. And we call that a real estate investment trust because it's held in a trust, which is a different legal structure to a company. So that's basically what it is. There are certain risks and responsibilities on a REIT. For example, when you own shares in a REIT, the profits that are made are typically passed back to you as a legal requirement, whereas a company can hold on to those profits and reinvest them. Typically, a REIT can't hold on to them for too long. So that's basically how that works. Eric's talked about VAP, which is an interesting one because this, just for those of you that don't know, the Vanguard Australian Property Securities Index ETF, it's actually an ETF that invests in REITs and other types of property companies. So it's a bit different. It's actually an ETF, whereas this is a REIT. So here we go. We can come in and we can see latest dividend from Charter Hall was 0.29. Well, that's dividends per share, current. So 0.29, let's go down. We can see a yield of 5.87. The last dividend was 0.76. So really interesting. I'm guessing, guys, I don't know much about this. So maybe Liam or anyone else that jumped into the chat with Charter Hall, do these guys pay their dividends quarterly, or I would imagine it's quarterly based on this number right here, meaning that they pay it every 3 months. I don't know for sure. Number 245 in ownership. It has 45% of people say that they're buying it for dividends. I will add in here some risks to consider when investing in property. Many people, quarterly, says Liam. Thanks, Liam. So many people don't often consider that many of these big REITs are exposed to interest rates. So they use debt and they use leverage to buy properties around Australia or sometimes around the world. And then if interest rates go up, just like a mortgage, the portfolio can be affected. So keep that in mind too. It's really, really, I guess, important that you remember, once again, the dividends are not guaranteed, even from a big and established REIT like this one. So let's have jump back in. So we know the yield on this one is 5.87%. So we'll just drop that back in here. So the Charter Hall Long WALE REIT, CLW, and I'll just capitalize that last one. And we'll go 5.8. Now, again, I want to emphasize, guys, this is a trailing yield. So this is last year's. It doesn't say what will happen next year. And the reason why I bring that up is that if you think about it, many REITs that invest in property are actually going to be affected by COVID and working from home and those types of things. So here, see down the bottom here how we've got DPS, common stock primary issue. This is basically showing you what's the dividends per share. DPS means dividends per share. And we can see in recent times, dividends have kind of fluctuated a little bit. So yes, they've been paid in the last few years, but they've fluctuated a little bit. So just keep that in mind. Okay, so we've got that in here. I doubt it's fully franked. If Liam or anyone in the chat wants to jump back in and tell us, is it fully franked? I can rely on you just for these example companies just to tell us, is it fully franked or are the dividends unfranked? Once you know the answer to that, I'll chuck it in the spreadsheet. I think I can guess what it will be. Let's just say we've got another 2% position in this. Okay, so now let's bring up a share. Which company does anyone want to chuck in? We saw some great companies earlier on, like Flight Centre, a few others. What else did we have earlier on? What are some shares that you're interested in? And if you bonus points, if you can tell me what it does, just really briefly, like what is the company and why is it interesting? Like Gilly Monster said earlier on, the Charter Hall Long WALE REIT, a sturdy, reliable income with potential for growth. Pietro said, suggested Batcore or BAP. Eugene suggested Spark. If you can tell me, Vishal suggested Woolworths, which is an interesting one. Tell me, if you tell me why, then we can talk about it. So Adam said 0% franking. Okay, so there's 0% franking. So we'll just go no, and this guy on the end here shouldn't change. So no. Yeah, Tywin says, how do you assess the future growth of a REIT? And that's really interesting. The best way I find to do that is if you go in, this is where it kind of relies on your analyst skills a bit. You have to come in and you have to find what the company is doing, what properties they're buying, how do they plan to grow. You can go into the annual reports, you can read about the companies, see which properties they own, see how they're valuing their assets, and use their website as another resource. Listen to the chairman's address, understand what they're doing to grow the value of their current assets, and also how they're going to expand. It looks like, I don't know much about this REIT, but it looks like they may have made an acquisition play recently, so that's really interesting. Okay, so let's have a look here. Liam West says, what percentage of your income portfolio towards REITs do you think, Owen? Yeah, so to be honest, if you're talking about me personally, Liam, I actually don't invest in any REITs. I actually don't invest in them, but it's and to be honest, it's a tough one to answer because that's going to depend on your own, I guess, situation, which you should speak to a financial planner about. But okay, that's a really good question to ask. I just don't really, maybe if I could back this out in a way. So I'm currently recording this from home, this video from home. This is a house that we bought not too long ago. And the important thing for me is that I already own a home. I don't want to then have my entire portfolio exposed to construction and building and REITs and those types of things because I already own property. I don't necessarily need to get that from my share portfolio. So I think it's reasonable to think about the whole picture, not just one little thing. So Michelle says, yes, there are some risks. I think it is worth it at this stage. Interesting. So Lau says APA, that's a fantastic one. Eric said BSL, strong outlook, but how China affects this. This is Blue Scope Steel, right? BSL is Blue Scope Steel, if I'm not mistaken. Yeah, that's a really interesting one. I haven't actually come across the company in quite a few years. It was actually struggling there for a long time, so I kind of kept my distance. If we go back to dividends, you can see dividends from a business like this, right? Here we go. This is an example of a business. If I was building a portfolio from scratch, I probably wouldn't use too many companies like this. And the reason why, and I'm not saying you wouldn't use it at all, it's just maybe it's in a different part of the portfolio, is because the dividend was very low for a very long time, and then all of a sudden it shot up. Whereas if we look at something like, say, Woolworths, again, that's not even dividends, that's why. If we come down the bottom here, as you guys will know, Woolworths and Coles have been fighting a bit of war against Aldi and the like recently, which we saw this fall off here. So we can see here that the dividends, even though they've fallen from a time ago, they're actually pretty consistent since. So that's probably more what I've been looking for. Okay, so yeah, so Chris asks, are you looking for shares that are paying dividends or potential growth? Obviously, it all depends on what you are aiming to do. Just for the purposes of this example, we're looking at companies that pay dividends, but I'm in the back of my mind, I'm also looking for companies that can grow their profits as well. Okay, so let's pick a company. For the sake of moving on, let's go with, I'm just going to pick one out of thin air. Let's just go. We've got Woolworths in there. Let's just use Woolworths. So we'll just chuck Woolworths in here. Woolies or Woolworths Limited. You might have a view on whether you like Woolies, Coles, or something else, but we've got Woolies. And then we'll come down here. So here we go. We've got yield 2.55%. Does anyone want to find out if Woolworths dividend is fully franked? For me, you can go into the announcements tab and go from there. And while someone is trying to find that, bonus points for whoever finds that, it was 2.5%. I will take a look at another question, which has just come through from T-Pund, who asks about Fortescue Metals Group. Yeah, so Fortescue, if you actually look, Fortescue is one of the most popular companies on SelfWealth right now. And the reason is, we talked about this last week. The reason is basically because of this huge run up, but then also the recent fall in iron ore prices. So it's a really interesting company that paid a massive dividend last year, a huge dividend. And now, because the share price has fallen, the dividend yield looks like it's 25%. But remember this, we look into the future when we invest. We don't look into the past. So when we buy a share today or any investment, what we're getting is the future returns, not what happened last year. So you've got to make a decision through your research. You can go back and watch our, say, Netflix episode, SelfWealth Live, where we talked about how to analyze a company, or even our Nanosonics one from a little while ago. And you can actually do the research yourself and determine if Fortescue is interesting. Okay, yeah, Michael T says 100% franked, and I think this is for Woolworths. Adam says Woolies 30% franked. I tell you what, guys, I'm going to show you again how we do this, just so we dot all of our I's and cross all of our T's. So we're going to Woolworths. We'll go into news and announcements. This is how I like to do it. I like to hear it straight from the company. There is actually another thing here that you can do, is you can typically go down and you can find where the dividend announcement was made. But for the sake of today and keeping it simple, what we're going to do is we're going to download this real quick. Just like that, snap. There it is. And we're going to do Command F, fully. So you can see here that all dividends, this is where it gets confusing, right? So we can see, I'm going to zoom right in. We've got the dividends for the year. But you can see here, all dividends are fully franked at the 30% tax rate. So this is where we can get confused, guys. So Adam, you're spot on. It's at the 30% tax rate, but also, Michael, you're spot on. It's 100% franked. So you're like, whoa, hold on a second, Owen. How can it be 30% and 100 at the same time? Well, this is a really interesting thing. So companies, big companies in Australia, pay tax at 30%, which means that most of them can pass those dividends on as fully franked dividends because they're paying tax 100% at 30%. So all of their profits is taxed at the 30% tax rate. And so they pass back fully franked dividends. That's a really interesting kind of percentages on percentages. But the way you think about it is, does the company pay the maximum amount of tax? Yes. Does it have franking credits available in its accounts? So you can go franking credits, and we can find out if we go back out here. So franking credits. We can see franking credits available for future. Here we go. And you can everyone can do this, guys. You just press Command F or whatever. G'day, Daniel. Franking credits available for future periods, tax paid, 30% tax rate. And you can see here, it says the above amount represents the balance of the franking credits at the end of the period, adjusted for, and then blah, 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 blah. It goes on and says how much franking credits are available. So what some private equity companies do and some big investment companies do, they actually look for companies that have huge franking credit balances like this one. And then they say, hey, can I get my hands on those franking credits and then pass them back to my investors? And then it ends as a whole different tax law thing. But it's a really interesting way because Australia is very unique with our franking credits. I think there are only 2 countries in the world, off the top of my head, that have a franking credit system. It's called imputation, by the way. It's not franking credits, it's just our Australian name for it. Okay, so we know it's a 2.5% yield from Woolies. We're going to put that in there. We've just chucked 2% in. We've said yes. Okay, there we go. We've got it at gross yield adjusted. Now, see this final cell down here, column down here. I should say that if the dividend is only partially franked, this formula doesn't work. So this is only for fully franked yields. Okay, so what would be a partially franked dividend? Just so I can fill this final blank in. So we've got no franking credits. So a company like Apple, for example, if it pays a dividend, so if Apple pays a dividend, it doesn't pay franking credits because it's not an Australian company, right? So if it pays a dividend, no franking. But if a company like, say, I don't know, Xero it's a Kiwi company, but let's say for the sake, it's an Australian company because it's a success, we'll claim it. Okay, let's say if Xero paid a dividend, oh no, Bapcor, someone suggested Bapcor earlier on. Here's a better example. So Bapcor is an Australian company that owns Autobarn and it also owns Ursons, which is the like automotive retail business and wholesale business. And basically, Burson's has an Australian business, but it also has a business in Asia. Now, that means that its dividends may or may not be fully franked. It may only have enough franking credits in the bank or in reserve to pay only partially franked. And so if you have a partially franked dividend, the maths for working it out becomes a little bit different. But you can work it out. Typically, there are heaps of resources online. Okay, so let's move on now. So we've got, here is someone just said, Jane said, Magellan Financial Group pays franked and unfranked. Yeah, so there may be an instance where a company pays a dividend and it says part of the dividend is fully franked and part of it is unfranked. Or they might say, we're going to pay a special dividend that's unfranked. So you need to know. Typically, when a company makes an announcement about dividends, you can go into the company's announcements tab here, and you can find out, typically down in here, they'll eventually post something about dividends. So if we come down, let's see if there's any dividend announcement. Oh, you know why? Because one's sensitive. So if we keep coming down, dividends, here we go. So these announcements are required by the ASX whenever a company wants to pay a dividend. So you can see here the name of the company that's paying the dividend. And then in here, it contains all of the information you need to know about the dividend. What type of dividend it is, how often it's going to be paid, the total dividend amount, what currency, is the dividend franked, does it have a dividend reinvestment plan, so on and so forth. So you can see in here, the ordinary dividend franked amount per security, how much of the dividend has foreign income, what's the tax rate. You can see all that stuff. So the percentage of the dividend that is franked, only 75%. Obviously, 100% franked is the most you can do. So keep that in mind. Okay, Magellan's actually a great company to consider for our next idea in here. So here's, I said we'll include a fund or a LIC. So what people don't really understand that are new to investing is that typically if you want to invest in something, let's say you want to invest in Magellan's global fund. So this is actually a really good case study. So Magellan is a fund manager in Australia. They help investors invest. So they invest in companies, and you can buy into their managed funds. However, Magellan also has their funds on the ASX. You can see here MGOC and MGF. So, for example, we could type this into SelfWealth, MGOC, Magellan Global Fund. And this is a managed fund. So this is just like a normal managed fund that you could fill out the paperwork for and invest in, but you can buy it via the ASX. Just like here, you can see a big green button here on SelfWealth. But what we might do to keep it really simple is we might look at another LIC. So MFF. So MFF is part of the Magellan group, but it's kind of separate. It's run by a different person. So many of you will know that Magellan was started by Hamish Douglas. I told you before that I've interviewed Hamish Douglas for the Australian Investors Podcast, and I've also spoken to him outside of that. But you will see that Hamish runs all of these funds, but there is one that he doesn't run, which is called MFF Capital. And this was actually started by his co-founder. So there's Hamish and then there's Chris. Chris is on the other side of the fence here, and he runs this one. And you can actually invest into this company. This is a listed investment company that invests in companies that are similar to the listed fund. So MFF, here it is on SelfWealth, and you can see here that it's got MFF Capital is an Australia-based investment company engaged in the investment in approximately 20 exchange-listed international Australian companies. So basically, it wants to buy at least 20 companies. We come into the announcements tab, we'll go price sensitive only, and we'll get the latest 4-year results from MFF Capital. So the way I think about this is MFF is like Magellan, and it's related to Magellan, but it's run by a different investor. So if we come into the chairman's letter and past that, we go through to the portfolio manager's letter, we can see the types of companies that are invested in. So here we go, blah, 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 all this fun stuff. So here's the portfolio manager's review. And you can see at June 30th, 2021, what was the MFF fund invested in? So let's just clarify what I mean here. So we've got you, maybe I'll switch screens real quick. We've got you, the investor. You use SelfWealth to buy shares in MFF, and MFF holds money and invests in other shares. And those other shares are the ones that are coming up right here. And these are companies like Visa, MasterCard, Amazon, Home Depot, Facebook, all of these companies. So you can see where the top companies are invested in. Hartley says ARK. Yeah, ARK Investment, really interesting, another company, another fund manager. But you could invest in basically anything. I'm just using MFF here as an example. I've actually never spoken to Chris McKay, who runs this. I don't, to be honest, I don't invest in any of the companies that we've mentioned so far. I haven't actually invested in any of them. So keep that in mind. But MFF, let's just put that here, MFF Capital. So this is like that. Now, you would have also seen, here is the dividend announcement from MFF. So if we just use this example, we can come in here, we can see that it paid a dividend of 3.5 cents per share here, and this would have been the final dividend. And we can, go on through here, and we could find out how much of it is franked. 100% of it is franked. Okay, so we've got 100% franked dividend. So yes, we'll make it a 2% position just to keep things really simple. And we'll go back into SelfWealth. Here we go, in here. We can see the last year was 2.23. And you're probably wondering, how does MFF, how does this company that invests in overseas company pay franking credits? Well, that's because you're investing in the company that's in Australia, not the companies that are overseas. That just happens to be what it does. And so let's pick one final ETF. Hartley asked, do you personally own Tesla shares? Hartley, no, I don't. I actually don't invest in Tesla. I don't own shares in Tesla. I wish I did, and I wish I bought it a few years ago. But hindsight's a wonderful thing, and it's in investing, it's one of those rarities. It's something we don't have. So Robin says, hi Owen, I understand that MGF earns its revenue through management fees from its funds. My question is, does the performance of the funds greatly influence ASX MGF performance? Yeah, so this is the thing. So the funds that I just mentioned, like these funds from Magellan, will charge fees. They will charge fees. Just like MFF also charges fees, although it doesn't charge as much, I believe. And the fees do eventually eat away at the performance. I think John Oliver said it best. He said, fees are like termites. They eat away at your proverbial future. And he basically was making the point that termites are basically unnoticeable until your house falls down. And high fees in investing can be like that, but they're not the only consideration that anyone should make. So Stevie says, when you own an ETF, you may have exposure to shares like Tesla. He says it's a great way to be diversified into various stocks/sectors. I mean, ETFs are a great way because you buy the basket. We've actually done some episodes on this in the past. If you go back into the SelfWealth Live archives, you will find that. So I'm just going to throw one out in the interest of time. I'm going to throw out the most boring ETF in Australia, which also happens to be the biggest ETF in Australia, Vanguard Australian Shares Index ETF, the VAS ETF, which is hugely, hugely interesting. Benzie says, hi Owen, thanks for the great information. You have one of the best presentation skills. Your educational content is fantastic. Thanks, Benzie. I really appreciate that. At Rask, we actually take a lot of pride in educating people. That's what we do for a living. So I'm thrilled you think so. So here we go. So it looks like this is the Vanguard Australian Shares Index ETF. And you can see the yield here says it's 3.39%. For those of you that don't know what this ETF is, this ETF invests, so again, I'll switch cameras. So this ETF, here's you, the investor, here's SelfWealth. You invest via SelfWealth into the Vanguard Australian Shares Index Fund or ETF here. And from there, that ETF holds 300 other shares from around Australia. And it's like a basket. You basically buy the basket, not the individual shares. And I'm just using that as an example. Obviously, there are so many different considerations you'd want to make. Past Assault says, does VAS utilize franking credits? This is a tremendous question. So most people, not most people, but many people don't actually know that you can get franking credits from your ETF. So you can earn franking credits. And the easiest way to find out, the easiest way to figure out if a fund provides franking credits is actually to go to their website. So they go to Vanguard VAS. Here we go. And actually see what it invests in, have a look at the performance, have a look at the metrics, the fees, how big it is. And you can do all of that on the website and just look at generally what it's doing. And the basics of ETF investing for income are this. So at the end of the year, all of your ETF providers, assuming you've set up your share registry correctly, so your link and your computer share, there's actually a great thing on this. SelfWealth share registries. Jared Purchase, the head of marketing at SelfWealth, actually wrote up this article, I believe, a little while ago, and basically explained how to use a share registry. And what a share registry is basically a way for you to tell the company what your bank account is, what your tax file number is, and all that sort of stuff. So then, for example, Vanguard can send you a letter in the mail in July each year that says, "Hi, Mr. or Mrs. Investor. This is how much franking credits you have. This is how much income you earn from the fund. This is how much capital gains you earn from the fund." Yeah, so Jane just says, VAS give you a tax statement at the end of the year with the franking credits on it. Exactly. And not many people know that. So shares ETF, so ASX VAS. I'm going to just use this in here. It's 3.39%. But I'm actually going to check that in a second because I don't think that's 100% correct. So I'm going to put yes with an asterisk. So yes means that it could be or it might not be. So Betty Sue says, "Hi Owen, do you only look at last year's dividend or will it be better to look at the past 3, 5 or 10 years and also since inception?" Jimmy asks, if one is already invested in Australian shares, shouldn't one look at ETFs investing in international shares? Absolutely. So there were 2 questions there. Yes, if I'm investing in an individual company, I do want to look at the dividends over multiple years. So a really good example of that was from earlier with Argo. Argo has paid dividends for many years. And so when people kindly suggested some companies and some ETFs here in the chat, I targeted the ones that I knew had a reliable dividend history. So if we come in here, we'll go get rid of that. And we'll go down to dividends. So there we go. And we can see dividends, I believe this, that's diluted earnings per share, dividends. We can see dividends from Argo over a very long time have been consistent, even though they've fallen in recent years. I would be much more inclined to look at something like this than something else. So, you know, if a company come out of nowhere, like say Fortescue, and paid a massive dividend, you have to be really, really careful, guys. I want to be clear. Dividends are not guaranteed. This is the whole point of the share market. Things are not guaranteed. Like, look at this. This is a dividend that looks like a hockey stick. For many years, the dividend was being paid, but it was very low while it was ramping up production of its iron ore facilities and prices were subdued. But then out of nowhere, Fortescue has paid a massive dividend. It's much like BHP. So I would just caution everyone to say, just be mindful that dividends are not guaranteed. And when you set out on your own journey of investing, you have to be really careful and scrutinize the reliability of a dividend, not just if it was paid in the last little while. So you can see here, even BHP's dividend is kind of bouncing all over the place. Okay, so yeah, Jimmy, just to come back to your point, obviously I provided this here as an example only, just to show you basically how to start building a portfolio. So Stevie says, I think 2020 is a good example of dividend payments being cancelled or much lower than previous years. Yeah, that's a great point, Stevie. So if you go back to say like NAB, which is a bank, and if you go back, I think it was NAB, Stevie, I could be wrong. You probably know. You actually look at those dividends. Look at that. So imagine if you invested here, like in this year here, thinking, oh, this is a great dividend stock. Look at its history. And then the next 2 years, it falls off a cliff in terms of its dividend being paid. That is the risk that you take. And that's why you want to be diversified. That's why you can never say that anything is guaranteed. You have to be very careful, guys. Very careful. So I want to emphasize that again. So do your research. Use all the tools that we've talked about in the past. Yeah, it's a pretty tough situation for a lot of people when you see this dividend fall off a cliff like that. That happened with a lot of the banks here in Australia. Happened with many companies around the world, actually. Okay, so finally, I'm just going to hit 2 more points on the head. So basically, we've put in our numbers here. We've come to a gross yield. That's given us an average down the bottom here. If this was the portfolio, all this total is here showing you is that if we had 2% of our investments in each of these companies, that's only 10% in total. The trailing dividend yield, again, is historical, so it's not a guarantee of the future. After we put franking credits in, that's what this one is over here. The average, based on the average yield here and $100,000 portfolio up here, that's the annual estimated yield. Estimated, keep that in mind. So $4,000. Obviously, you can tinker around and have a play. This is just an example. And if anyone wants to download this, just click on the file at the top here and then click download as Excel. So this thing right here. So download as Excel, and then you can play around with it. This is just a template. It's a very basic one, to be honest. It's not a great one. If you want to look at there are other services you can use. Like you can use SelfWealth's watch list on the left-hand side here. And one final thing we talked about, where does property come into it? Well, I did a bit of research ahead of time for you, and I wanted to show you, basically, we've got the yields of these investments. Now you can use a website like SQM, and you can see what it is, according to SQM, how much does an average property yield? So an investment property, how much does that yield? And this is gross rental yield. So there are a lot more costs that go into a property than a share portfolio. So keep that in mind. That's a really interesting one, SQM research. And you can see that all around Australia, the average yield on a property is 2.6%. So that's basically it. And someone asked about bonds earlier on. You could do the same calculation here with your portfolio, trying to work out what are term deposits paying, what are the, if you have a hybrids, if you have all these different things, you go in and throw some numbers in there. Always great to learn from you, Owen, says Robin. Thanks, Robin. Got to go. Have a great day, Robin. One final thing, someone asked about bonds. Through SelfWealth, you can buy into any number of different ETFs. So there are ETFs like this one, which is the iShares Core Composite Bond ETF. You can find out about this portfolio by just jumping in here, having a look around at the share price charts, and then you can find out more on the website. You can go to the News and Announcements tab. We don't have it in here, actually. You can go onto the website of the ETF provider and find out more about that. Okay, so we've run over time as usual. We talked about a lot in this session, and I'm sorry if I spoke really quickly. I was just trying to get through it all in a time that was reasonable. This type of thing that we talked about right here is actually best done with a financial planner, because they can help you. They can sit down with you and say, this is the strategy you want to use. This is how you're going to do it. Typically with a portfolio, it takes many, many years to earn a passive income. You need to build up your portfolio to the point where you're happy with it, to the point where your advisor's happy with it. We've talked about a lot of different companies. From memory, all of the different companies that we've talked about here, I don't actually think I own any of them. So I don't say that to scare you off. It's just more so just to know that I'm not recommending any of them. It's just, we're just using them as examples. Amit says, thanks, Owen. Amazing as always. Thank you, Amit. I'm really, really pleased you come along. Plant One, I think you're a season ticket holder. Like a good sports member, you show up every week, so it's great to see you. And Eric, thanks. Always a pleasure, mate. So thank you, everyone, for joining us. Don't forget, if you have questions, use the hashtag SelfWealthLive. You can watch this on replay. You can just hit subscribe on SelfWealth there. We're going to talk about investing for kids in future episodes. We're going to talk about all different types of stuff. So yeah, Chanda, good to see you. Jonesy, always a good session with you, mate. So thank you so much. Always great to chat with you guys. Remember to head to selfwealth.com.au. You can find out and start researching all of your own companies, apply all of the different strategies you learn here, and you can find us on social media. So as always, I'm Owen Rask from Rask Australia. Thanks for joining us. Rob and I, it's always a pleasure to have you with us. Thanks again.